As expected by most market participants, the Fed cut interest rate by 25 basis points on Wednesday. The Fed actually joining a global movement to ease monetary policy. We've heard from the ECB last week that a 10 basis point deposit rate cut is very likely in September, and more monetary easing may come by way of net asset purchases later on. For Euro fixed income market, the message from the ECB is quite clear. The coming 10 basis points rate cut in September will lead to lower bond yields across the board. We still find some value in sovereign space, particularly at the long end of the French and Belgian curve, which have room to flatten from here. Italy is still one of the key sources of volatility in the sovereign space, especially as Fitch Ratings prepares to update its rating on August 9th. There's scope for a reduction, one notch reduction in rating on that date, so that could bring about more volatility on Italy. Otherwise, we're quite confident that other peripheral will do well. In credit space, there's great hopes and expectations for new net asset purchases in credit. That's clear to favor investment grade bonds, and we've seen plenty of flows coming in the asset class as spreads tighten to less than 100 basis points over bonds of late. In high yield, we're slightly more concerned by valuations, and we once again would highlight the fact that spreads might come higher in the coming weeks. In US equity markets, there's a tug of war between rich valuation made possible by Fed policy and the earnings season, which comes in slightly disappointing. 4% EPS growth is not magic, and there's guidance for lower earnings ahead, so it's difficult to make new highs from here in the US equity market. In Europe, we have a slightly better earnings season. We have also the push from monetary policy, so that's scope for a bit of a pickup in relative performance of European equities.